Now, joining us to discuss the mix of global and market news is Richard Bottger, a portfolio manager at Tower Capital Management. But the story dominating the headlines today is what Lesetja Kganyago just said live on CNBC Africa. Another cut in 100 basis points. Prime rate 7.75%, repo rate down to 4.25%. My question to you, Richard, is what difference is this going to make?
Yes, hi there, Chris. Unprecedented times, notwithstanding another tremendous cut in the repo rate, unprecedented by the SARB, who's increasingly always acted with significant caution and always been very, very moderate in their cuts. I think it's important to understand that, everybody's really shooting in the dark, and notwithstanding all these fiscal and monetary measures that have been taking place, I think that analysts are probably underestimating aspects at all points. Just a couple of weeks ago, the Reserve Bank was suggesting that there'd be 427,000 jobs lost. Today, they're saying 1 million. That's a factor of 2 merely in a week. So everybody's really shooting in the dark. I think what is important is that one needs to understand that in 100 years, the global economy has never shut down so quickly. Many people, including our government, quite frankly, just don't understand the damages caused by what's happened. And certainly the world will not be the same place. This is not merely a blip. If one casts one mind back to other turbulent times in financial markets, certainly this time does require a look back at an experience of sorts. And 2008 was largely a financial and real estate crisis that spread through other industry sectors through a contagion effect. Most service sectors remained completely unharmed. And this time, nothing's been spared. Services, tourism, restaurants, hairdressers, countless small businesses. Any business that closes its doors for more than 30 days sees a massive cash flow deterioration. Cash flows dry up. And this is probably unique in history. I was reading some suggestions that were saying that 20% of global GDP could be wiped off as a result of COVID-19, and that would be a function if you had a disruption for more than 60 days. And it's quite interesting when one really places emphasis on that disruption. The economy is not just going to merely be a light switch that one flicks back on, like we see in load shedding, where we have load off, load on. This is going to take some time, and certainly a V-shaped recovery, like some market professionals out there, including a man you have a lot of respect for, Larry Fink, believe that this would merely be a V-shaped recovery. Certainly the view that I disagree with that, quite frankly.
Well, talking about shooting in the dark, I mean, Lesetja Kganyago of the Reserve Bank was saying just 3 weeks ago they expected the economy to contract by 0.2%, and now they're saying 6.1%, which is incredible. But then again, he's predicting the economy to grow by 2.2% next year in 2021 and 2.7% in 2022. Surely that's a bit on the optimistic side.
Yeah, absolutely. I think that would be a remarkable outcome. And I don't believe that is going to happen. You need to understand the multiplier effect that one has in South Africa, where essentially each job, it kind of sustains 10 miles, 10 people. So if we're going to lose 1 million jobs, which is a ghastly thought, that's a further 10 million people that are going to be disrupted. And it's not like South Africa isn't plagued with massive unemployment and crime, etc. So I think the government actually doesn't know what's going on and is very much in the dark. And the sooner that the president and his merry men get together and have some contingency plan associated with a World Bank bailout or an IMF bailout, the better, because quite frankly, this disruption that's just been extended for a 30-day lockdown is going to have tremendous effects with the employers of South African people, which largely the SMMEs. And the South African government just doesn't have the pockets to really sustain the help needed and required in this level. And it's disdainful to think of the SAEs and how they've been bailed out time and time again. When we have the billionaires of South Africa putting together a fund, it's within a week or two, 3 times oversubscribed. So it just shows the lack of resources that South Africa really does to cope with this crisis that's unprecedented. Never in history has a fall been this sudden from a market peak to a depreciation of 30%, and never in the history of the world has all business been closed for a period of 30 days. It's unprecedented, and cash flows are what sustain businesses, and this disruption is something that's going to have far-reaching effects that I don't think are understood by the Reserve Bank, and its estimations are anywhere close to where we're going to end up.
Well, speaking about that growth story, I'm reminded of a conversation I had with Mike Moore, the former head of the World Trade Organization, about growth, probably about 20 years ago. He was bald, by the way, and he said, well, if I get one hair on my head, you can call that growth if you like, but it's all relative. But how do you think this economy is going to emerge from this, looking like? You think there's going to be major structural changes? What are you predicting?
Yeah, absolutely. Because, the most important element is that with these very loose monetary policies that we had during the boom years, the world has created an absolutely outstanding mountain of debt. And, a slowdown was inevitable. We were already seeing a slowdown early in 2020, and the global economy was being hit even before COVID-19 came about. And obviously, boom and bust is very much part of the economic cycle. But on top of this, we saw a new price war in the oil market in early March. And the question is, does lower oil price, is that not good for the economy in this case? And it's important to understand that the shale oil industry is basically bankrupt in the U.S. And these companies have more than $900 billion in outstanding debt. So this eats its way through the financial system, jeopardizes the refinancing of many companies, and that also affects the real economy. And I think once again, this shows how dangerous an excessive buildup of corporate debt is. And we're going to have to muddle our way through that before there's going to be any growth or any ability to really, wipe our eyes from what is a nightmare that's going to have extensive effects and far-reaching effects that I don't think people are necessarily recognizing, how important the employer engine of the economy is, and that's the small kind of spaza shops and hairdressers and everything else, where the vast majority of the economy and people that actually fund the fiscus, the state tax system, are going to end up unemployed and without jobs. And as other market commentators suggested, they're going to be a whole lot less people eating Easter eggs this time next year, notwithstanding a muddle through that we're going to have to get through. But I certainly don't believe that it's just going to be a quick bounce back. And, in an environment where you've got a whole lot of bigger companies already defaulting, it's very difficult to suggest that, 30 days or a disruption of 30 days is something that we get over within a period of even a couple of years.